Welcome back to this week's edition of the RiskSpotlight Operational Risk News Update. My name is Emily Jones, and today I'll bring you essential updates and insights from the world of operational risk. All information is sourced from the RiskSpotlight Portal, the premier forward-looking service for operational risk content. Let's get started. First, we have a major regulatory change coming up in the UK. On the 1st of September 2025, the new offense of failure to prevent fraud will take effect under the Economic Crime and Corporate Transparency Act 2023. This law introduces strict liability for organizations whose employees or associated persons commit fraud offenses to benefit the organization or its clients. The types of fraud covered range from misstatements in accounts to misleading warranties and even greenwashing claims. Similar to the UK's Bribery Act 2010 and the Failure to Prevent Facilitation of Tax Evasion offense, organizations can only defend themselves by demonstrating they had reasonable fraud prevention procedures in place. This law applies to both UK and non-UK organizations that meet at least two of the following criteria: turnover above £36 million, a balance sheet total over £18 million, or more than 250 employees. Even overseas companies could be liable if their UK-linked operations commit fraud that impacts UK clients or markets. Fund managers, investment firms, and multinational corporations will need to be particularly careful in assessing who qualifies as an associated person, as subsidiaries and portfolio companies with a UK nexus may fall within the scope of the offense. With penalties including unlimited fines and reputational damage, organizations need to conduct risk assessments, update fraud prevention procedures, and train employees before the law takes effect. Shifting our focus to the world of financial fraud, a recent report from Chainalysis highlights a surge in pig butchering cryptocurrency scams, relationship investment frauds that manipulate victims into fraudulent crypto investments. A 40% year-over-year surge in pig butchering crypto scams, with a 210% rise in fraudulent deposits is reported. Scammers use dating apps, social media, and wrong number messages to build trust before tricking victims into fake investments. These schemes falsely show gains but block withdrawals, demanding extra fees. The US CFTC urges whistleblowers to report such scams, offering rewards of 10 to 30% of sanctions, with past payouts reaching $200 million. The CFTC also launched the Dating or Defrauding campaign to raise awareness. Now, let's talk about a worrying cybersecurity trend. Attackers are increasingly using fake CAPTCHA verification pages to trick employees into downloading malware. Security firms have reported a sharp rise in incidents where employees are lured to fraudulent CAPTCHA screens and instructed to copy and paste malicious scripts into their systems. These scams typically start with phishing emails, fake security alerts, or deceptive web pages, leading victims to unknowingly execute malware, such as the Lumma-Stealer information stealing software. Despite awareness campaigns, this tactic remains effective, with thousands of employees falling victim each month. Security experts recommend several key defenses: monitoring for suspicious activity, enforcing phishing-resistant multi-factor authentication, and disabling browser password-saving features. Organizations are also advised to educate employees on never pasting commands into their computers unless explicitly instructed by IT security teams. Cyber threats don't stop there. A February 2025 report from Pewaments Intelligence and Arculus highlights a rise in fraud against banks, with 87% of institutions reporting increases in stolen or falsified credentials over the past year. Stolen credentials now account for 41% of all fraud-related losses, making account takeovers and fraudulent transactions the biggest challenges. To combat this, banks are exploring tap-to-authenticate metal payment cards, which provide enhanced security by using contactless authentication. According to the report, larger banks, particularly those with over $100 billion in assets, are leading the adoption of this technology, with 92% expressing interest. Smaller banks remain more hesitant, but overall, the industry is shifting towards more secure authentication methods to mitigate the growing fraud risk. Another major cybersecurity concern comes from third-party vendor breaches. According to cybersecurity firm Resilience, 47% of organizations suffered a disruptive outage in the past year due to a third-party breach. The issue is especially concerning for mid-sized companies, which are becoming prime targets for cybercriminals in what experts call big game hunting. A separate report from Checkpoint reveals that supply chain attacks surged 179% year-over-year in 2024, highlighting the growing risk posed by vendor security gaps. Despite these risks, many organizations lack confidence in their third-party security controls, with only 35% expressing strong trust in their vendors' cybersecurity measures. Larger enterprises with over £750 million in turnover report slightly higher confidence levels, but smaller firms remain particularly vulnerable. The takeaway? Organizations must strengthen their vendor risk management frameworks, conduct rigorous security assessments, and ensure contractual obligations for cybersecurity standards among suppliers. Now, let's touch on the evolving climate disclosure landscape in the U.S. The SEC's 2024 climate disclosure rules face potential rollback under the Trump administration, with acting SEC Chair Mark Uyeda calling them deeply flawed. Meanwhile, California is pushing forward with its own climate disclosure laws, requiring emissions and risk reporting from large companies operating in the state. New York and Illinois are considering similar legislation, while in the European Union, potential changes to the Corporate Sustainability Reporting Directive, CSRD, could affect international compliance requirements. Companies need to prepare for a fragmented regulatory environment, ensuring consistency in climate-related disclosures across multiple jurisdictions. And finally, let's talk about Agentic AI, autonomous AI systems capable of making independent decisions. While Agentic AI has enormous potential, it also raises serious privacy and security concerns. These systems can collect vast amounts of personal data, raising risks of surveillance, profiling, and non-compliance with privacy laws like GDPR and CCPA. There's also the danger of AI-driven cyber attacks, where bad actors could exploit Agentic AI for social engineering, data breaches, and identity theft. To mitigate these risks, organizations must implement strict data access controls, conduct regular AI audits, and foster a privacy-centric culture. Ensuring transparency in AI decision-making and securing AI-driven processes will be key to navigating this emerging risk. Now let's turn to key operational risk loss events reported last week. The first update is on MasterCard's £200 million settlement in a landmark UK class action case over card fees, which faced backlash after the initial £10 billion claim was dramatically reduced, leaving consumers with potential payouts of just $2.27 each. Litigation funder Insworth Capital, which invested over £45 million in the case, opposed the deal, arguing it undervalued the claim and set a concerning precedent for returns on class action funding. The UK's Competition Appeal Tribunal approved the settlement this week, sparking debates over the future of collective redress mechanisms and corporate accountability in British courts. The next update is on Aviva India's recent $7.5 million penalty imposed by Indian authorities for a fake invoice scheme that spanned from 2017 to 2023. The insurer allegedly funneled $26 million through vendors to pay excess agent commissions, evading $5.2 million in taxes, which is nearly half of its $10 million annual profit reported last fiscal year. While Aviva plans to appeal the ruling, emphasizing no operational impact, this case highlights regulatory scrutiny in India's insurance sector over unlawful financial practices. The next update is on the recent Finastra data breach that impacted customers in Massachusetts and potentially globally. The UK-based fintech giant discovered unauthorized access to its secure file transfer platform between late October and early November 2024, compromising 400 gigabytes of data, including names and financial details. Finastra began notifying affected individuals in February 2025, offering 2 years of credit monitoring while downplaying risks, though experts warn the stolen banking data could surface on dark web markets. That concludes this week's operational risk updates. For more on these topics and additional insights, visit the RiskSpotlight Portal. If you're a subscriber, log in or go to riskspotlight.com to sign up for a free trial. Thanks for tuning in, and until next time, stay safe and keep those risks in check.